What if I told you there's a company sitting at the crossroads of artificial intelligence, blockchain, and a $4 billion healthcare revolution, and it just lost 42% of its value in 30 days? Would you call that a disaster? Or would you call that the buying opportunity of the year? Welcome back to Smart Stock Sam, the channel where we cut through the noise, strip away the hype, and find out what's really happening inside the stocks everyone is talking about. I'm Sam, and today we are going deep on one of the most polarizing tickers on the market right now, Datavault AI, trading under the symbol DVLT. This stock has everything: explosive revenue growth, a celebrity partnership, a massive pharmaceutical deal, and yet the chart looks like it fell off a cliff. So is this a hidden diamond in the rough? Or is Wall Street trying to warn you about something the press releases aren't saying out loud? Stay with me, because there is one hidden metric buried inside these financials that will completely flip how you see this stock. By the end of this video, you will have a clear-eyed, actionable understanding of whether DVLT belongs in your portfolio or nowhere near it. Let's get into it. But before we talk about where Datavault is going, you have to understand what it used to be, because this company has been through a complete reinvention. Not long ago, this was WISA Technologies, a company focused on high-end wireless audio solutions. Think premium speaker systems for home theater enthusiasts. It was a niche business, steady, somewhat predictable. Then management looked in the mirror and decided that niche and predictable wasn't going to cut it in the age of artificial intelligence. So they made a decision that is either genius or reckless. We're going to find out which. They are splitting the company in two. The core entity, which keeps the DVLT ticker, is being repositioned as an AI, blockchain, and data monetization platform. Meanwhile, they're spinning off the audio division into an entirely new publicly traded company called API Media, trading under the ticker ADIO. The logic from management is actually pretty straightforward. They believe the market doesn't know how to value a company that sells wireless speakers on Monday and deploys drone-based pharmaceutical logistics on Tuesday. So the strategy is to separate the two, unlock distinct valuations for each business, and let each entity stand on its own merits. It's what investors call a sum-of-the-parts play, and on paper, it makes sense. Companies like this have unlocked enormous value through clean separations before. The problem? This restructuring is happening right at the exact moment when the company's cash burn is hitting levels that are very hard to ignore. And that brings us to the numbers that really matter. Look at the growth on paper, and your jaw will drop. In the first quarter of 2026, Datavault reported revenue growth of over 442% compared to the same quarter the prior year, 442%. Their quarterly revenue hit $3.4 million, and their trailing 12-month revenue now stands at nearly $42 million. In almost any corner of the investment world, those numbers would trigger a standing ovation. That is the kind of top-line growth that turns small-cap stocks into mid-cap legends overnight. But here is the part of the story that doesn't make the press releases. Their EBITDA, which is their earnings before interest, taxes, depreciation, and amortization, and the most widely used measure of operational profitability, is sitting at negative $42 million. Negative $42 million. Let that sink in. Over the last 12 months, for every single dollar of revenue this company brought through the door, they burned through roughly another dollar just to run the business, fund the research, and service the expansion. They missed analyst earnings per share estimates. They are, by every definition of the term, a heavy development, loss-making entity with an enormous profitability gap to close. So why is anyone excited? Because of one single massive headline that management believes changes the entire equation. This is what they're calling the big bet, and it is big. Datavault has signed a binding term sheet with Wellgistics Health to launch a joint venture called DeliverMeds AI. The stated valuation of this venture at launch? $4 billion. Now let's be very clear about what they are actually trying to build here, because the scope is genuinely ambitious. DeliverMeds AI is designed to be an end-to-end digital ecosystem for pharmaceutical distribution. We're talking about the acquisition of QOLPOM intellectual property, which covers biometric drone-based logistics for medication delivery. We're talking about a controlling stake in Talo Health, a telemedicine platform with a focus on GLP-1 weight loss drugs, one of the hottest pharmaceutical categories on the planet right now. And we're talking about connecting over 6,500 independent pharmacies and more than 200 manufacturers through a blockchain-enabled infrastructure. If this works, and I mean if, Datavault would essentially own the digital pipe through which a significant chunk of American pharmaceutical commerce flows. That is not a small idea. That is an industry-defining idea. But here is the phrase that every experienced investor needs to lock onto. The $4 billion valuation is currently, and I quote, subject to a fairness opinion. In the world of finance, those 4 words mean one thing. We haven't proven this number yet. Could a third-party evaluator come back and confirm the $4 billion figure? Absolutely. Could they come back with something significantly lower? Also, absolutely. Right now, it is a number written on a term sheet, not a number verified by an independent balance sheet. Keep that in your back pocket as we keep going. Now, if your company is burning $42 million a year and needs to fund a $4 billion ambition, how do you generate public excitement? You find a face that the whole world recognizes, and Datavault went to the very top of that list. They signed 2-time world heavyweight boxing champion Tyson Fury as their international brand spokesperson. Fury isn't just endorsing a product, he's the face of the Sports Illustrated Exchange, a platform designed around name, image, and likeness monetization for professional athletes. This is a play into the Web 3.0 space, trying to bridge massive sports audiences with digital asset ownership. Tyson Fury is a global icon. He makes people pay attention. But as investors, we have to ask the uncomfortable question the marketing team doesn't want you asking. Is a celebrity partnership with a world champion the highest return use of capital for a company bleeding millions per quarter? Is this a brilliant brand-building move? Or an expensive distraction pulling resources away from the core technology that actually has to work? I'll let you sit with that, because the answer tells you a lot about management's priorities. Speaking of management priorities, let's talk about who is actually putting real money into this company, because the institutional data reveals a split that is genuinely fascinating. Right now, there are 101 institutional owners collectively holding over 46 million shares, and the behavior between them could not be more different. On one side, you have Vanguard Group, one of the largest asset managers on the planet, and Vanguard increased its position in DVLT by 912% at the end of 2025. 912%. That is a deliberate, significant accumulation signaling index eligibility and long-term structural confidence. But on the other side, you have State Street and Jane Street Group. Jane Street is one of the most sophisticated quantitative trading firms in the world, people who run algorithmic models around the clock hunting for risk-adjusted returns. And Jane Street significantly reduced or entirely closed its DVLT position in the first quarter of 2026. Think about what that contrast means. The patient, long-term indexers are buying. The sharp, short-term quants are selling. When two groups of professionals with completely different time horizons reach completely opposite conclusions about the same stock, it tells you the answer is genuinely not obvious, and that the short-term risk-reward profile may be deteriorating even as the long-term thesis slowly builds. But if the institutional split is confusing, what I'm about to show you is the clearest signal in this entire story, and it is not a positive one. In the past 6 months, insiders at Datavault AI have made 20 open market share sales. 20. The number of open market purchases by insiders in that same period? 0. Not 1. Silex Holding Company dumped over 31 million shares worth approximately $32 million. CEO Nathaniel Bradley has been selling. CFO Brett Moyer has been selling. Now, I'll be fair. Executives sell shares for all kinds of legitimate reasons: taxes, estate planning, personal financial obligations. Selling alone doesn't automatically signal bearishness. But here is the critical detail: this company just fell 42% in 30 days. If you genuinely believed your stock was massively undervalued at these prices, you would be buying the dip, publicly demonstrating confidence by opening your own wallet. The fact that not a single insider has made one open market purchase after a 42% crash tells you something profound. The people with the most information don't believe we've hit the bottom. They are reducing exposure while publicly discussing a $4 billion future. You have to reconcile those two things yourself. Wall Street is trying to reconcile them too, and the result is cautious. Maxim Group still carries a buy rating on DVLT, but in their most recent analyst note, they slashed their price target from $4 all the way down to $3, a 25% reduction in conviction. And the reason is not the technology. They actually like the intellectual property portfolio. The reason is equity dilution. Datavault is losing roughly $42 million per year while simultaneously funding drone acquisitions, telemedicine platforms, and blockchain infrastructure. The only way to bridge that gap is to raise capital by issuing new shares. Every new share issued means every existing shareholder owns a smaller percentage of the company. It is a slow, structural transfer of value away from current shareholders toward the institutional buyers of freshly printed stock. Maxim likes the assets, but they are heavily discounting the valuation because the shareholder dilution engine is running wide open, with no clear timeline for when it stops. The technical picture confirms the pressure. Every major moving average is sitting above the current price like a wall. The 200-day moving average is up at 62 cents. That is your long-term resistance ceiling. Below that, the 100-day is at 51 cents and the 50-day is at 48 cents. We're currently trading around 46 cents. The only thing providing any near-term floor is the 5-day moving average sitting down at approximately 42 cents. In terms of momentum, the 14-day RSI is at 48, which reads as neutral, but the faster 6-day RSI recently bottomed out at 22. That is deeply oversold territory, and it explains the 11% bounce we saw on May 22nd. The MACD, which measures directional momentum, is sitting at negative 0.019, and the histogram is expanding further to the downside. Translation: the short-term bounce may have bought a few days of breathing room, but the underlying momentum is still pointing lower. This is not a clean, healthy recovery. This is a technically broken stock looking for a floor. And the search for that floor gets even more complicated when you factor in the short interest and the dark pool data. Right now, over 81 million shares are sold short, representing approximately 13.6% of the float. That's meaningful short pressure. However, the days to cover ratio is only 1.5, which means a dramatic short squeeze is unlikely without extraordinary sustained volume that simply hasn't materialized. What's arguably more significant is where the trading is happening. Nearly 59% of all DVLT volume is occurring off-exchange in dark pools, private trading venues where large institutional orders get executed away from the public market. When dark pool volume runs that high, it creates what traders call price suppression. Every time retail enthusiasm tries to push the stock higher, those dark pool flows act like a ceiling, absorbing buying pressure before it can move the price. It's why this stock keeps bouncing and then stalling. The visible market wants to go higher, but the invisible market keeps pushing back. Given all of that, here is the specific, actionable setup for the week of May 26th through May 29th. Your entry zone is between 43.5 cents and 44 cents. That's where you want to be watching for support near the 5-day moving average. Your primary take-profit zone is between 51 and 55 cents. If the stock reaches that band where the 100-day moving average and overhead supply converge, you take the gain and you step aside, and your hard stop loss is 38 cents. If DVLT breaks below 38 cents on any meaningful volume, the next significant support is down near the 52-week low of 25 cents, and that's a lot of pain you do not want to be holding through. 3 rules of engagement before you touch this stock. Rule 1. Anticipate fragility. DVLT is a technically compromised asset right now. Expect sharp intraday reversals. Expect high volatility. Do not hold through them hoping for a miracle. Trade the range with discipline. Rule 2. Respect the dark pools. That 58 to 59% off-exchange volume is not going away overnight. Do not get greedy expecting a sustained vertical rally. The ceiling is real and it is structural. Rule 3, and this is the most important one, sell on DeliverMeds news. Historically, every major positive headline from this company has been followed by negative price action the next day, as insiders and institutional holders use the temporary retail excitement and liquidity spike to reduce their positions. Buy the rumor if you choose to. Absolutely sell the news. So what is the final verdict? As a short-term swing trade for the week ahead, DVLT is a viable, tactical, high-risk setup. The oversold RSI, Fibonacci support confluence, and the potential for news-driven momentum create a defined, tradable range. Get in carefully, define your risk with that stop loss, and take profits at resistance. Scalp it. Don't fall in love with it, but as a long-term investment in its current state. In my honest assessment, DVLT is uninvestable right now. You cannot build a long-term position around a company with negative $42 million in EBITDA, an open-ended equity dilution machine, and a C-suite that is aggressively selling its own shares into a 42% crash. The $4 billion vision may be real. The technology may be genuinely transformative. But vision and reality are two very different things, and right now, the gap between them is filled with risk that is not yet compensated by the current price. Until the share count stabilizes, until the losses begin meaningfully reversing, and until insiders demonstrate confidence by actually buying their own stock, the long-term risk here far outweighs the reward. Now, before I give you my final wrap-up, I need to be very clear about something important. Everything you have heard in this video is for educational and informational purposes only. I am not a licensed financial advisor, broker, or investment professional. Nothing in this video constitutes personalized investment advice, and nothing here should be taken as a recommendation to buy, sell, or hold any security. All investing involves risk, including the potential loss of the entire principal you invest. The stock market is volatile, and speculative small-cap stocks like DVLT carry substantially higher risk than the broader market. Always do your own independent research. Consult with a qualified financial professional before making any investment decision, and never trade or invest with money you cannot afford to lose. Past performance of any stock or strategy is never a guarantee of future results. Now, let's bring it home. Datavault AI is one of the most genuinely fascinating paradoxes in today's small-cap market. An asset that is simultaneously growing at 442% and losing $42 million. A company targeting a $4 billion healthcare platform while its insiders quietly sell into the decline. A stock with Vanguard buying 912% more shares while Jane Street heads for the exit. The DVLT paradox is real, and which side of it you land on depends entirely on your time horizon, your risk tolerance, and your honest assessment of whether management can close the massive gap between what they are promising and what they have actually built. So here is the question I want you to answer in the comments below. If you had to pick just one factor that would make or break DVLT as a long-term investment, would it be the DeliverMeds valuation getting confirmed or the dilution machine slowing down? Drop your answer below and tell me why, because I genuinely want to hear how Smart Stock Sam's community is thinking about this one. If this breakdown gave you value today, and I truly hope it did, smash that like button. It helps this channel reach more investors who need this kind of no-fluff analysis. And if you're not subscribed yet, hit that subscribe button and ring the bell so you never miss a breakdown like this one. Lastly, if you want to go above and beyond and support this channel directly, you can send a super thanks right here on YouTube. Every single one means the world and helps us keep making content that actually matters. I'll see you in the next one. Stay sharp, manage your risk, and as always, trade smart.